In the game of loans, you either win or you learn. Welcome to the game of loans, where fortunes are forged and empires are built. Your hosts, lords of lending and wholesaling, are here to guide you through the realm of real estate and wealth building. Brace yourselves, cash flow is coming. '20th episode of the Game of Loans. So for this episode, because it's the 20th and it's a landmark, we wanted to answer some questions for some of our followers. So that's what we're going to do. We have followers from all different places and we're going to answer them.
All right, let's do it.
Okay, so you're first.
Okay. Question number 1. If I work a 9 to 5 and don't want to leave my job, what's the best way to get into real estate investing?
The best way to get into real estate investing if you work a 9 to 5. Well, I always say that the best and the first investment should be a house that you own for yourself. So if you don't own a house, the best way to be able to get into real estate would be to purchase a house for yourself, right?
Okay.
Now, people are going to say, "Well, I only have $5,000 fucking dollars." There are USDA loans that you can get into that are 100% financing. And right now, sellers are agreeing to add closing costs into the purchase price, right, to help for the closing costs.
And just for, our followers, what is a USDA loan?
A USDA loan is a government loan that you can get in certain geographical areas, right?
More so a tertiary market.
Not necessarily.
Okay.
Could be a secondary market, not necessarily tertiary. Okay. But there's places, even like New York, where you can get a USDA loan. But more obviously here, we're in Tennessee.
Sure.
There's more of that around.
More opportunity.
More opportunities for
Definitely.
USDA loan. It's actually very prevalent also in places like Hawaii.
Oh, wow.
Yeah. Very, very. Which is, you would never think,
yeah.
Right? But there are obviously income limitations, right? I don't think you can make over $148,000 or something like that.
I think it depends on location too.
Location, and also I think the income limitation is universal though.
Oh, is it?
Yeah,
okay.
yeah,
I thought it was specific geographically.
No, I don't think
No?
on that
Okay.
one. For FHA there is.
Yeah.
But this is different. So you have 100% financing. You could do USDA. If you're a veteran, you can do 100% financing, VA loan. Now, let's say you can't. You're not a veteran and you're not living in a place where you could have a USDA.
Sure.
You could choose to move, go somewhere more affordable, which
Yeah.
isn't bad.
Yeah.
I mean, I did it multiple times. Or you can try and get these down payment assistance programs, right? Through the FHA. They're rampant. They're all over the fucking place. I mean, I see that all the time. So that 3.5% down, you can get some, assistance with the down payment assistance. You can get grants. There's a lot of creative ways that you could get into a property. So that's a first investment, buy a fucking house for yourself. Now, if you could get a 2, 3, or 4 unit, that's even better. Right? Because let's say you get a 2 unit, you occupy one, you rent out the other one, and it's going to subsidize your payment. Sometimes you're going to be paying less than your fucking rent if you could do that. That's going to enable you to kind of feel out how it's like to be a landlord and see if you like it, right? Now, you get that 2 unit, you can rinse and repeat. You can upgrade, go get another one, rent out the the unit you were living in.
I have a recommendation as well. So if you don't have a ton of capital, but you do want to get into it, that's why networking is so important, because you could potentially meet other investors who are looking for capital partners.
Very good, right?
And then you can invest that $10,000, $5,000, whatever it may be. And no, it's not going to be a massive return, but you could potentially double your money, right?
You can.
And then rinse and repeat that way as well. And then eventually do your own project.
Yeah. I remember when I was younger, one of the first deals that I bought with 2 of my best friends, right? I mean, back then homes were a lot cheaper than they are today, but we put up, I think, $3,000 each. We came up with 9 G's, and we did that first deal together.
Yeah,
which was great, and we were all working 9 to 5, and we were able to pull that off. And like you said, we actually tripled our money.
Yep.
So then we kept doing it. We did like 4 or 5 projects together, and everybody went on their own merry way, doing projects on their own. But that's a great idea. That's a very good idea. Put your money together.
Yep.
Find other people that, I would say if you can, keep it with friends and family first, because you never know if you're going to partner up with
100%.
people that you don't know and how that's going to be, right? But to answer your question, that's the best way. Either buy a primary residence for yourself first, get a 2-unit, 3-unit, 4-unit, figure out how you're going to, what it's like being a landlord, rinse and repeat, move on. Or like Melissa suggested, pull up your money with other people, hopefully friends and family, so that you can have some substantial down payment or capital together, get into a deal together, double, triple your money that way, and you're on your way. Next one. This question for you. Can I invest with real estate with just $5,000?
And the answer is no, because you're a broke bitch. No, I'm just kidding.
You're kidding.
Absolutely. So it really just depends on the market. So that's why it's so important to go out there, understand what property values look like, also the type of loan, right? But depending on where you are lending, the greater the property value, the greater your down payment is going to be. In markets like Ohio, for example, or Chicago, St. Louis, you could potentially buy an investment property for $50,000, $75,000, right? So, and
probably less. Yeah.
Depending on the area, very possible. I think in Ohio, I just closed on a deal, which is very rare because I only do $1 million deals. But I just closed on a 4-unit that was $75,000. Yeah. And you can imagine the profit on that, right? Your mortgage payments.
You can get an FHA loan on that too.
You can get an FHA loan on that too. That goes back to what we were just talking about.
You could probably even get a down payment assistance on something like that.
So yes, where there's a will, there's a way.
100%.
Now, if you're in Los Angeles and you're saying, I want to buy a property and I have $5,000, that is not going to be an option.
No.
But going back to the question we just answered, partnering up with other individuals so you can increase those funds so that you can have a sufficient down payment.
Yeah, I agree. I think that's a great idea.
Next question. Which is better for your property and profit long term? Renting it short term on Airbnb or renting it long term to tenants?
Are you sure you want me to answer this?
Why? Yeah.
Oh. Everyone thinks, including you, that I'm against short-term rental. It's not the case. What I always try to tell people is that social media has blown up short-term rentals to a point where these properties are becoming so expensive, right? That outside of short-term rentals, they're not able to, God forbid, if they want to get out of the short-term rental, they're not going to be able to cover the rents with long-term rentals, right? And I always try to tell people that get into a situation where if, God forbid, short-term rentals go away, that investment is still going to make sense, right? Where you're going to be able to survive and debt service with a long-term rental in place, right? What does that mean? It means if my payment turns out to be $3,500, I better fucking make sure that in the long-term rental market there, I'm going to be able to get $3,500 a month from somebody who wants to rent it for 12 or 24 months or whatever the fuck the lease is, and that market is going to make sure that I cover that $3,500 payment with a long-term rental, with a long-term renter. Now, if it can't, me personally, I'm out. I'm not fucking doing the deal. And that's it. And a lot of people are like, oh, but, I can't, blah, 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 and it won't change. Bullshit.
Yeah.
The guys that own these hotels, they're owned by the big boys, right? The Blackstones and the BlackRocks. And these guys have so much fucking money, you're never going to, you never know. You never know what's going to happen. I mean, even in a place like, Nashville, they're feeling the heat right now. So
Totally.
So that's the answer, and I'm sticking with it.
Okay.
So
all right, I'll do the next one.
Next one. How can someone buy a rental property with no credit or low income?
That's a great question. So with no credit, my first answer would be to get a cosigner. So even in private lending, most lenders do require minimum trade lines. So if you've never had a credit card or any type of debt at all, you most likely don't even have a credit score. With that said, if you can get another sponsor, another borrower to co-sign with you, we only need one individual on the loan with a credit score. And the credit requirements are very minimal when it comes to private lending. Now, the next piece of that question is, what about no income? All day, every day, because we don't require income, right? We do not look at individuals' income documentation whatsoever.
Asset-based only.
We are asset-based lenders. What that means exactly is we are underwriting the property, the project itself. So we are not looking at you from an income standpoint. We are looking at the profitability of the project.
That's correct. So, to add on to that, though, is if you're coming to us and you have low income, meaning you don't show that much income, but you better have the assets.
Correct.
Because we're going to require a down payment.
We are looking at liquidity.
Correct.
Yes.
Liquidity we're looking at, and you're going to have to put down at least 20% when it comes to asset-based lending, which is important.
10%.
10%?
10%.
No, for a rental, for a long-term rental, this is, not for a project.
No, it's not.
Yeah.
Did it say rental?
Yes.
Did it?
Oh yeah, rental property.
Yeah, it's a rental property.
Oh, but you could be fixing and holding.
You can. You could fix and then refinance it.
It sounds better, 10%.
True.
Say it again.
10%. Look, 10%. All right, next question.
I'll do it. It's my turn.
Do it.
Okay. Next question. What's the biggest money trap first-time real estate investors fall into?
Okay. First-time real estate investors, the biggest money trap that they fall into is a couple of things. One thing is they're always looking at the highest comps that they could get. Right?
Yep.
And that's a big fucking mistake. No, I'm not saying always.
Versus what's actually comparable to the property.
Correct. Or, still, even if they're looking at the comparable, they're looking at the highest.
Correct.
Right? Because they have a real estate investor or not a real estate investor. They have an agent, real estate broker or agent singing in their ear, or they have a wholesaler giving them information. Yep. My recommendation to them always is, how I like to do it, I'm always looking at the fucking worst case scenario. Now, if you don't want to be that fucking cynical, look at the middle of the pack, and that's the number you should go at. But look at the lowest one as well to make sure you're not working for free at the end of the day, right? Because what ends up happening is they'll do all the work, they'll do all of this, then they'll sell it at the lowest comp, and they're fucked because they didn't make any money, so they just did it as practice, right? So that's, to me, is the biggest trap. The other thing is, that goes along with that, they'll convince themselves to do it because they're getting emotionally involved in the property. And I tell them, get emotionally involved when it's your primary residence. You're allowed. But don't get emotionally involved in the property. That's a fucking investment.
100%.
And that's what they do. And when they get emotionally involved in that, then they allow themselves to talk themselves into the scenario that we just said.
Yep.
Looking at the highest comp, looking at everything as rosy, and that's not the case. Don't fucking sell yourself into a bad deal.
Yep.
That's all I have to say. Next question.
You.
Can I get a loan for a real estate investment if I have no experience?
The answer to that is 100% yes. You do not need any experience to acquire a property with a private, as long as you go with a private lender, right? So if you're using a private lender, you can acquire property. We do not require experience depending on what the project is, right? Sorry, what was the question?
Can you acquire
rental?
Property?
Was it?
Nope.
Oh, it wasn't rental this
Nope,
time. Okay, okay.
No, it's a real estate investment.
Yep. So yes, the answer is yes. You can acquire a property without any experience.
Can you explain to them what types of loans you could qualify for? Though?
Absolutely.
Because obviously, like we talked about before, we get a lot of people that are saying, oh, I want to build a luxury fucking property.
Yep.
I want to build it from scratch. I have zero experience. Can they do that?
So not necessarily, but potentially.
Correct.
So let me explain why. For a first-time investor that has no experience ever, there are a few requirements. So one, it cannot be a heavy rehab project. Heavy rehab is going to be the total dollar amount of the renovation, or it cannot exceed 50% of the as-is value. Okay. So if you are buying a house for $500,000 and you want to have a budget of $300,000, that's not going to work for a first-time investor.
Because it exceeds $250,000, which is 50%.
Well, no, exactly.
Correct.
Exactly, because it exceeds 50% of the current as-is value.
Correct.
Now, let's say, so that's why I said you could potentially get a luxury property, right? So let's say you were able to find a property for $1 million.
Yep.
You have the liquidity for the down payment, and you're looking to put in $150,000 in renovation. As a first-time investor, we could do that all day long. So, depending on where in the state the property is, that could very well be a luxury property. Now, what you want to consider as a first-time investor is that the best decision for you to get into, right? Do you want to get into $1 million property on your very first project?
Yeah.
Now, if where you live, that is the common property value, very possible.
I think that's California, right?
I mean, if you live in Franklin or Brentwood.
Yeah, but even if you live in Franklin or Brentwood, a lot of times when we talk, we don't realize that a lot of people live in, other parts of the United States.
Sure.
What's the average home price outside of, these places? It's usually anywhere between $350,000 to $400,000, let's say, right? So for them, if we take those numbers, that's going to be the average investor out there. It's not that bad. They can potentially buy a house for $300,000, right?
Yep.
Put $30,000 into it and be able to sell it for $460,000. So that would be better, right?
100%.
Can you purchase $1 million house or $1 million investment as if it's your first, project?
You 100% can purchase or acquire $1 million property as a first-time investor.
How?
Right? So there are some caveats to that, and there's a few things you want to be mindful of. One, if it's going to be a fix and flip deal, the renovation budget cannot exceed 50% of the purchase price.
Which is what in this case?
Which would be $500,000 in this case.
All right.
Right? Next, what was next? Okay. No. We changed our guideline to $300,000, so let me not use that scenario.
This is for this.
Yeah, nobody gives a shit, right? Watch, someone's gonna call. You fucking said.
Yeah, but still, it's right.
I know.
So it would be less than 30. You just say you'd have to keep it at somewhere less.
No, we'll leave it at 50%. I don't give a shit.
No. What I'm saying is make sure. I recommend that you don't get into something that's greater than 25%.
Yeah. Okay.
You understand what I'm saying?
Yep. Okay. Let me go. With that said. Yes.
What we would do is light rehab. Light rehab would be considered anywhere between 25 to 30%
Yes.
maximum of
Yes.
the purchase price. Huh?
Okay. Now, with that said, as a first-time investor, I would recommend not getting anywhere higher on the renovation budget at 25 to 30% of that purchase price.
So would you say that 25 to 30% below that would be considered a light rehab?
That absolutely would be considered a light rehab project.
So in this scenario, at $1 million purchase, what would that mean? The rehab cost would be where?
So we'd be looking anywhere from $250,000 to $300,000.
$250,000. So that would be
Yep.
light rehab here, right?
Correct.
If it was $100,000 property, it would be somewhere between $25,000 to $30,000.
Exactly.
Right?
So we're
the
talking
numbers could work.
percentage. Yes.
Right. So now, after repair value, what we would call ARV, where would we have to be over here?
So for a first-time investor,
Yeah.
we would need to be at 70% of the after completed value.
Okay.
Meaning our loan amount cannot exceed 70% of that final completed value.
Final completed value. Okay. That's great. That's
Yep.
fantastic. I
That
think,
is.
if someone, now, do you recommend someone doing that, or do you recommend that somebody start with something smaller?
You know, it really just depends on your current liquidity, right? If you just came into a ton of money or no, that wouldn't make sense. If you just came into a ton of money and you find a phenomenal deal that happens to be $1 million purchase, absolutely. I
Okay.
think that would be a great scenario considering all the numbers work out and there's profitability in the deal, right?
But also, it's also the market. Don't you agree? Right?
Absolutely.
It's the market. So if you're somewhere in California, then that could work because the average home price in California is $1 million.
Yep.
Right? It's a little bit shy
So
of
you
$1
really
million.
wouldn't have much option.
Right. But also, they have to understand that $1 million properties plus don't move as fast as affordable homes.
They do not.
Right.
Correct.
So that's also, so they have to have that longevity in
Yep.
mind as well.
He just has to shit on my stuff.
I,
I'm just
right.
kidding.
I have to shit on it.
Okay, next question. Is flipping houses still profitable or is there a better strategy now?
It's a fantastic question. It really depends on the region, right? The problem with finding a good flip today in a market is that people got into loans at such low fucking rates
Yeah.
that they just don't want to leave,
Yep.
right? So when you're in a loan for 2%, 2.5%, 3%, it's not that much activity over there. So in a primary market, you're just not going to find any good deals. It's an unfortunate fucking situation unless you're going to get that one gem because of a scenario that happened. God
Sure.
forbid, bankruptcy, foreclosure, something like that. But meanwhile, it's 100 motherfuckers to one deal, and then
Yep.
they're going to just drive it up again. Now, if you're willing to go, like I am with some of my partners in real estate, into secondary or tertiary markets, yes. But again, there's a gamble. When you get into those markets, you better get into a market where something's fucking going on. What do I mean? There's a plant that's going up, or Oracle is moving there. Fucking some sort of activity is happening, right? Pay attention, because unless you do that, you're fucked. You might get a good deal, but you might not be able to sell.
Yep.
And so be cognizant of that.
Yeah. So, and what I'm noticing from my clients right now is they are holding, right? So that's another thing you need to look into is even though the profit might be there from an ARV standpoint, an after repaired value standpoint, does the property debt service? Right? So you need to look
Correct.
at it from both angles.
Yeah.
One, is there profit in the deal? And two, if I'm going to hold that property, will my property debt service?
So I agree. And I think in secondary and tertiary markets, usually it does.
Yeah.
Right?
Yep.
Because you're getting in at such a cheap cost basis.
Yeah.
That the rent usually in those markets are covering.
Yep.
Right?
Yep.
It's in a market like Nashville, where you have
Sure.
to be very cognizant because it's probably not going to debt
Yep,
service.
absolutely.
Unless your cost basis is really good.
Yep.
And you're not finding that in fix and flips. Where you're finding it with your clients is in ground up construction.
Exactly.
But now, again, I don't want to promote that because a lot of people are going to fucking hit me up or hit you up and say, I'm a first-time investor. I want to do a ground-up construction project, and then it's a 30-minute fight of why they shouldn't do it.
I know,
right? And then they're not happy with your fucking answers.
Do you notice how my answers are short and sweet, and his are 10 minutes long?
That's because I have a lot more knowledge than you do. Your capacity is only fucking short and sweet. My capacity is fucking 30 minutes. Charlie from Cincinnati asked you specifically, Melissa.
Okay.
What is the
Charlie.
success? Charlie wants to know.
Okay.
What is the success rate of your clientele and why?
So first and foremost, I only have the best clients, right?
True.
No,
we
but
have the best clients.
Our success rate is 100%. I have very, very successful clients that, one, know what they're doing, but two, are willing and understanding to take my advice when I might see potential issues with the deal structure that they've set up.
Like what?
For instance, the budget being too large,
Okay.
right? Maybe they're doing an over improvement for the area. So I'll let them know, hey, if we can get the budget down a bit, maybe $50,000, whatever it is, we can make this deal work, right?
Because of the comps?
It could be because of comps,
Okay.
right? It could be because of profitability. So maybe they've already done their assessment. They have an after repaired value, but they're not seeing that they're lacking some profitability there. So
Right.
even though from a loan standpoint, the numbers might work, but we're still lacking on profit. We still want to ensure that there is some end profit in the deal.
Okay.
Now, another option would be to see, like we were saying a second ago, maybe there isn't a ton of profit in the deal, but the intent is to hold that property,
I
right?
think what a lot of people don't see is how many people you're talking out of a deal into a deal.
That's
right?
another 100%.
Right.
So they might bring me a scenario in which they think is a good deal, but then once we do the exercise and go through all the numbers, at the end of the day, it's not the best scenario for them.
I like to tell people, analyze the deal like as if you're loaning yourself money.
Yep.
Would you loan yourself fucking money on this deal?
Yeah, exactly.
Right? And a lot of times it's being objective.
Yep.
And a lot of people aren't. Even the seasoned guys,
Yeah.
right? They want to fucking get aggressive. And I think you're a great backstop to that.
Yes.
Where you're analyzing it as, hey, I'm giving you money. I'm fucking not going to give you money on this one.
Yep.
Because, you're not going to win.
X, Y, and Z.
X, Y, and Z.
Yep.
So good. Very good.
So basically, if I'm giving the yes to lend money, that means the deal is going to succeed.
And by money, she means my fucking money.
That's right.
Melissa, Maria from Michigan would like to know, why would I use a private lender like you for a real estate project if I could go to a bank?
Well, one, because banks are shit. No, but all joking aside.
Yeah, today.
All joking aside, and that's a great question. So there's multiple reasons why you would use a private lender over a conventional bank. One is timing. We can close a loan in as little as 5 days, right? A bank, their standard turn time is 45 to 60 days.
Yeah.
So timing. Two is income. If you can't show income or you don't qualify with a bank based off your debt to income ratio, you would absolutely use a private lender. Another one.
So meaning what? That you're basically you're just looking at the asset. You're not looking at the personal income.
Exactly.
Okay.
We are asset-based lenders.
Okay.
We are looking at the project itself. We are not looking at the individual's income.
And what's more important also is that you're looking to make sure that they have some sort of history, right? You care more about,
A borrower's experience.
experience, right?
Correct.
Right.
Now, with that said, we do lend to first-time
Yes, you
investors
do.
as well.
Yeah.
But correct, depending on the project, the greater the experience, the better the terms are going to be, right? Higher leverage, better interest rates,
exactly,
and so forth.
Right.
The last thing, which you threw me off, and now hold on, what was it? Okay. And so the last thing would be higher leverage. Often banks are going to be capped at 75 to 80% of the total cost of the project, requiring you to give a greater down payment. We can go as high as 92.5% of the project, therefore really minimizing that down payment. So what do we have? Speed, no income to qualify, and higher leverage.
Amazing. And that's why you should call her to borrow money.
Okay, next question is from Enrique in New Mexico.
Oh, love it. Enrique. Is his last name Iglesias?
Okay, so Enrique from New Mexico says, what's a DSCR loan and why is everyone talking about it?
Well, this is the fun part of this question. Guess who created the fucking DSCR loan? Me. I'm one of them. So, a DSCR loan is a debt service coverage ratio loan. That means it has nothing to do with someone's income. It has to do with the subject property's ability to debt service. Okay. Meaning, if I have a property and the PITI, the principal, interest, taxes, and insurance, turns out to be $2,000, right? The property should have the ability to debt service, meaning I should be able to rent it for $2,000 if my payment is $2,000. Now, in certain circumstances, that doesn't even need to happen anymore. That means even if my PITI, my mortgage payment, is $2,000 and I can cover, $1,500, we will even be able to lend on what's called a negative debt service today.
Okay.
We don't like to do it, but in certain circumstances.
Like what circumstance?
What circumstance?
Gotcha, motherfucker.
Yeah, you did. No, you did. So, the circumstance would be, let's say we're in a market where we feel that the rents are going to come up at some point.
Okay.
Right? Or that the property happens to be that white elephant.
Sure. Right? Or I think in areas where property values are higher, but we know that it's still a strong market.
Yes. It could be that. Or it could be we just disagree.
Who's the fucking teacher now?
No. Or we just disagree with, because we have to use the comps that it's common and customary right now in that market.
Okay.
Right? But like you said, it could be a builder that built such a fucking house where the common and customary rents are, let's say, $5,000. But we're looking at it and we're saying, no, man, this one has a pool, this has this is that. Although these homes are getting $5,000, we think that this guy's going to be able to get that $6,500 to cover.
Okay.
So
what you're saying is you'll use that $6,500 to determine the debt service?
No, we won't. We're going to obviously lower our leverage.
Okay.
The rate's going to be a little bit higher.
Okay.
But we're willing to take a risk and say, hey, maybe you can't get 75% cash out, but we'll be at 65%.
Okay.
Right?
Sure.
And we believe in your project. We think that you're going to be able to get that rent, although right now the market isn't supporting it. Hence, that's what we would do. This is a question from Eduardo from Nashville. How do I analyze a rental property is actually going to cash flow?
Okay, that's a great question, Eduardo from Nashville.
From Nashville.
So what you would do is you would want to look at other rental comparables in the area.
How do they do that?
So if you don't have access to certain sites, the best thing you could do is reach out to your real estate agent, because your real estate agent can pull comparables for you.
On the MLS.
Yes, that is correct. You can definitely go out and get an appraisal on your own.
Yeah.
And it's what they call a 1007. It's a specific form that compares rentals within the area.
Okay.
Yep. So what you would do is see what other homes that are similar to yours, right? You don't want to if your home is 2,000 square feet, you don't want to compare it to the 4,000 square feet properties that possibly are in the area, right? Because they're going to get greater rent than you are. So want
like for like.
Like for like, exactly. So you'll want to see what other properties in the area are collecting rents on a home that's similar to yours.
Okay.
Then you would identify what type of loan you would get, right? What type of leverage you'll be able to get, meaning what your LTV is going to be, what your loan amount's going to be, right? Because that's how your payment is going to be dependent. It's going to be on your loan amount and your interest rate. So once you determine what the expenses are compared to the monthly rental income, you can analyze to see if that's going to be a profitable deal.
Very good. So what would happen if somebody is looking to do short-term rentals in a particular
Great
place?
question. So there's a great tool out there called AirDNA, and it gives you an assessment on what short-term rentals are making that are like for like, right? So other short-term rental comparables in that area. So if you have a 2-bedroom, 2-bath, whatever it may be, this site will analyze what they determine your annual or monthly net rental income will be.
Perfect.
I have a great question.
Yes.
I've been hearing a lot about this specifically in Nashville, where you can sell your entity for an Airbnb.
So
can you explain what that is?
Yes. So what happens in places like Nashville is that, like I always fucking said is going to happen, a lot of people that have Airbnb properties, right now the zoning has changed.
Okay.
Meaning that if they sell the property, just the property loses the right to be able to do short-term rentals. Okay? So how are they getting away with this?
Yep.
What they have to do is they have to sell the LLC or the corporation or whatever the fuck it's under along with the property. In order for the property to be able to be grandfathered in to be able to still do short-term rentals. Okay? Now, it gets a little bit tricky on how we do it, but we're able as an organization to do that today, to be able to let the borrower buy the LLC along with the property in order to be able to be grandfathered in to be able to still do the short-term rentals.
That's amazing.
Within that property. So if you have something like that, give Melissa a call and we'll be able to help you.
I actually just closed on one. So definitely, it wasn't an Airbnb, but yes, it was a situation in which they bought the entity. So we closed on the entity along with the asset.
And we're not going to give you the secret sauce, so don't ask. Just call us. Bang!
If you could give one piece of advice in real estate, what would it be?
Okay, great question. So I'm going to go back to law school. When I was graduating law school, the dean of students said, in your life, whatever you decide to do, stay consistent. My answer to this, like in life, is when you're in the real estate business, as in life, stay consistent. What does that mean? It means if you are venturing and you're doing residential properties, stay consistent. Do that. Become an expert in that. Don't start delving into commercial or anything like that. You can graduate, and you could be a fix and flipper, graduate, become a builder, and then graduate, going into commercial, right? But don't hop around. Don't start fucking, just doing different things and be inconsistent, because you're never going to be, you won't be successful, right? Someone who is in, and you'll see this all the time, right, in our business. Somebody who's doing residential real estate very rarely travels into commercial. And someone who's doing commercial very rarely travels into the residential space. Because although they're both, let's say, fruit, one's an apple, but one's a fucking banana.
Yeah.
Right? So
It's very different.
It's very fucking different.
Yep.
Right? Now, consistency is important, and that's the one advice I would give.
Nice.
Now,
That's great.
I'll flip it on you.
Okay.
If you could give any advice to real estate investors to be successful, what would you say?
So, and this can really apply to anything, but specific to real estate, I would say knowledge is key. Mm-hmm. So, and that goes for everything, right? Truly understanding how a project works, diving into understanding what profitability is. Mm-hmm. Why do I need comparables? Why is taking out debt versus using my cash important? Truly understanding all aspects of the deal, regardless of what part of real estate you're in, mm-hmm. is going to be the key to your success.
Don't just shoot from the hip.
Don't just shoot from the hip. Taking risk is another great thing, mm-hmm. but be mindful with it, right? Don't just shoot from the hip.
Educated risk.
Yep, exactly. Educated risk.
Which is phenomenal. I agree. Very good. So this is a wrap. We got a lot of questions from a lot of different people from different places. Shout out to you all. We're going to close out this episode. Thank you, Melissa, for being here.
Thank you.
And remember, if you have questions for us, always DM us, and we'll make sure that we're going to answer them either in the next episode or one of the episodes that's going to come. See you later. You'll get yours. You've been listening to The Game of Loans, where real estate battles are fought and won. Make sure to fortify your defenses by subscribing. Cash flow is coming, and we'll be back next time to help you claim your throne. The war of wealth continues.